Have you ever been so frustrated with your CPA? You're like, I cannot wait to fire them. Or perhaps you've already fired them and you feel this huge sense of relief. Well, if you feel this way, you're not alone. Trust me, I've been there before, and I hear this all the time when I'm talking with clients and with prospective clients. So I want to talk about how CPAs can actually hurt your business from a financial performance perspective, which you may be thinking, Steve, isn't my CPA there to help me make more money and to save on taxes and to make good business decisions? And the answer is yes, they are, right? And I'm a CPA and I can say this stuff. I can knock CPAs because I am a CPA, but I am more finance driven versus accounting driven, even though my background is in both. I have a CPA. I spend a lot of time in the world of accounting. I got my undergraduate in accounting. I got my master's in accountancy. I worked in public accounting, but also I got my undergrad in finance, and I also got my MBA with a focus and emphasis in finance and international strategy. So that's where I could tie all this stuff together. So let me just share with you some of the pain points that I see out there in the world, and maybe you can relate, but more importantly, maybe you can avoid some of these traps and save yourself a lot of heartache and a lot of money in the process. Okay, so here's why CPAs can be bad for businesses. But before I get into this, I'm going to give you 3 things here to walk away with. Let me just say this. Not all CPAs are bad. Actually, right now, I have an awesome CPA. She's amazing. I've been with her for over a decade, and I can't talk more highly about her. So she does a great job for me. I also know a lot of other great CPAs out there. So I'm not just like poo-pooing all the CPAs out there. I just want to point out those that cause harm to businesses and show you why, and hopefully help you to avoid these traps. All right, so here's the biggest reason why CPAs can hurt your business. Number 1, they're so focused on compliance and the transactional side of your business that they miss the bigger picture. I remember back in the day, I was working in public accounting, and I would talk to my friends all the time about their clients, right? We were working for the same firm, so there's nothing confidential here. And I would say to them, hey, what client are you on? And they'd say, oh, I'm on this, health science business, or I'm working in this retail business or this tech company. And I'd say, okay, that's interesting. So how are they capitalized? Where do they get their money? How much revenue do they earn? What do their margins look like? And I would ask them all these questions. I probably annoyed them to no end, but I was very curious about not just like the audited financial statements, but the economics of the business, the strategy of the business, the competitive advantage of the business, the customers that they served and how they serve them and all these different things. And more times than not, okay, and these are smart people, more times than not, they couldn't even tell me about their clients from a macro level. In fact, sometimes I'd say, how much revenue do they do? They're like, I don't know. Actually, Steve, that's kind of funny that you say that. I should probably pay more attention. I've just been so into the weeds of looking at general ledger accounts that I kind of forgot to step back and take a look. I'm going to go look at that, Steve. Thanks for the reminder, right? And that's what they'd say. But I realized this early on that you can get so lost in the weeds of things, you can get into the transactional, the day-to-day, that if you don't lift up your head, then you're going to miss like the story behind the numbers. That's why I'm so passionate about teaching people the story behind the numbers. It's not just about reading an income statement, a balance sheet, a statement of cash flows. It's understanding what's the story behind the income statement. What's going on? Okay, margin slipping. Why is it slipping? What are some things we could do about it? What are the 3 things we could do to improve margin right now today? And when I'm working with companies, I sit down with them in week 3 or week 4, and we review the financial statements and we compare that to the strategy of the business. And we say, okay, are these initiatives still relevant? What do we need to change? How's the performance going? What do we need to shift over here? Do we need to change pricing? Are our costs running too high? What's going on with our throughput? These are all the questions that I bring up, and these are the types of conversations we're having. Now, if you're just so stuck on the compliance side of things, you're like, oh yeah, according to ASO 5.6 guidance, it says blah, 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 blah. Well, guess what? You're missing the economics of the business, right? And that's where real value is created. I mean, you could only cut yourself so far, right? If you're trying to drive value by reducing costs, or you're trying to create value by doing weird things or saving on compliance or whatever, like, yeah, you're not going to drive a lot of value long-term. Value is driven in so many other ways, like through price premiums, through cost and capital efficiencies, through growth, by getting more customers, by making customers more valuable, by improving your LTV to CAC ratio. All of these things will improve your business far greater than staying compliant and focusing on the transactional. Here's just another quick story here. When I was a CFO of this billion-dollar company, all right, so day one, I go into the company and I realize like right away, there's like way too much complexity here. They had so many chart of accounts. They're tracking everything. And in fact, they were tracking ice, like ice that you put in a cup, and they were tracking food for the break room. So you may be like, okay, what's wrong with that? Well, all right, number one, ice, that's a whole other conversation. It is so immaterial, right? Like how much money do you actually spend on ice for your break room? Like $1,000 a year, $3,000 a year, even if it's $10,000 a year, compared to $1 billion in revenue is nothing. But what made it even worse is that they were taking these costs, these food costs, which were nominal, right? They were nothing. And they were dividing them up among 6 different divisions that shared the kitchen. And I was like, what the heck? We're doing journal entries, due to, due froms, and all this stuff. And that's just an example of one line item. I mean, imagine with like office supplies or shared legal costs or, marketing expenses or whatever it was. It doesn't mean that it's bad to share those costs, but it just means that they were so lost in the compliance and the transactional side of things, trying to make the books exactly right and trying to account for every single penny and how it is spent. Guess what? They were missing out on their margins. There were like 5 things that I did immediately to improve their margin that they were missing out on. So they were trying to track $1,000 right here, but they were losing millions of dollars over here. So it's crazy. And I think CPAs can do the same thing. They can just get tunnel focused and they can get lost in translation. So that's number one. Number two is that oftentimes the financial statements that CPAs construct, right? They're according to GAAP. I'm not saying they make up some random financial statements, but their financial statements are structured in a way that's convenient for them to do taxes instead of matching the true economics of the business. Here's what I mean. I just did this just a couple of weeks ago. I was going back and forth with the CPA because I wanted to move some things that were down in operating expenses up above in cost of goods sold. And the reason why I move accounts around on the financial statements is because I want the financial statements to reflect economic reality. All right, that's what it comes down to. In other words, if it's a cost associated with fulfilling a product or service, that's a cost of goods sold. And if it's not represented up in cost of goods sold, guess what? You're going to overstate or understate your gross margin. You may be like, okay, what's the big deal with that? Well, guess what? Then when you go to do your pricing, you're going to be tricking yourself because your gross margin's off. Or if you ever try to figure out your break-even points, you're going to be tricking yourself because your gross margin's off. You're not going to understand the true economics of your business. And that's why it's so critical to get the chart of accounts structured correctly, the financial statements structured correctly, so you can make economic decisions about the business rather than having financials that are convenient for tax purposes. Here's another example. Maybe this is true in your company. Most businesses, they have direct labor associated with producing or fulfilling their products and services. In other words, all the costs associated, the labor costs associated with delivering their products and services to their customers is one type of expense for the business, and that should be up in cost of goods sold. Then the other payroll type is general and administrative payroll. That should be down below in operating expenses or OpEx. But a lot of companies that I work with, especially the smaller ones, they'll have just one line item. All their payroll is hitting one line item and it's down in operating expenses, and they don't break it out. So then, once again, you have your material costs, your subcontractor costs, and your other direct and indirect costs up above in cost of goods sold. That's good. But one of your biggest costs in business is not even being reflected up in cost of goods sold. All right, so if this is you, this is something that needs to be changed like ASAP. Otherwise, like I said, you're tricking yourself. So be aware of that. And it's funny because when I work with companies, that's the first thing I do. I help them to restructure their financial statements to tell the true story of the business so we could get the financials aligned with the strategy, and then we could build a forecast, and then we can help them to drive performance. But when they're working with a CPA, that CPA could get so defensive. So if you're listening to this and you're a CPA and you're like, well, okay, don't get defensive. It's not like you own the chart of accounts or you invented the chart of accounts. Yeah, maybe you structured it that way, but hey, you could always change things. But I tell you, these CPAs, they get so upset. They're like, why are we changing this stuff? Why does Coltivar want to make these changes? They just get so frustrated. And I'm like, just make the changes because we need to show the true economics of the business, and you're doing a disservice to your clients because they don't even know their true numbers. So make the changes. All right, so this is a little side note, but I come across that all the time. That's my little rant. So that's number two, is that CPAs oftentimes don't align the reporting of the company with the true economics of the business. And number three, the third thing is that they're so focused on tax, or they're so focused on the compliance and transactional side of things that I don't know if they're just trying to invent ways to drive value, but they sometimes give terrible advice. I was working with a company last year and they were restructuring their business, and guess what? Their CPA had them buy property for the business, their building, and it was held in an S corporation structure. And I could tell you that's the worst structure to own property in. All right. So they ended up paying more taxes on this property because their CPA had them just put it in the S corporation instead of opening a LLC and putting the property in an LLC that's separate and distinct from the S corporation. But let alone, they not only failed to protect the assets of the business and reduce their liability, they also made a decision that cost them more in tax. All right. So don't do that. The other thing that I see with CPAs is that they'll go to business owners and they're like, okay, check this out. You're an LLC. Your tax is a partnership by default. We're going to convert you to an S Corp because if you convert your tax election to an S Corp, you're still an LLC as an entity, a legal entity, you're LLC. But if you change your tax election to an S Corp, then you could pay yourself W-2 wages, but then you can also take distributions, and those distributions aren't subject to Medicare and Social Security match, and therefore, voila, you save money. And entrepreneurs are like, yeah, that is great. That's a great idea. And look, this isn't tax advice for you, so whatever you do, go seek legal and tax advice. Don't just follow what I'm saying here. I'm just talking generally. They will say, okay, let's convert our LLC to an S Corp, and they do that without realizing that, okay, now you're an S Corp, and there are limitations on companies that are S Corps. So for example, you can only have individual investors. You're limited to the number of investors that you have. You can't make disproportionate distributions. There are more compliance costs. There are all these things that can limit your growth in the future. So I found this when I was a CFO of this large company. We went to go raise capital, and guess what? We were an S corporation. It was set up years and years ago, like 40 years before that. But now we wanted to raise outside capital, and guess what? Sometimes you could go to outside investors and say, hey, do you want to invest in my company? They'll say, sure, but I don't want to invest as Steve Coughran. I want to invest as Coughran Holdings, LLC. So you can't do that because the LLC can't invest in the S Corp. Only individuals can, but I may not want to invest individually. I may want to invest through my trust or through another investment company or LLC to limit my exposure. So guess what? It was very difficult to raise capital, and we really struggled. And if we converted to an LLC, guess what? There was a tax consequence. So these are just some things that I want to point out. Like I said, I don't want to demonize CPAs. I'm a CPA. There are a lot of great CPAs out there. I just want you to be aware of what goes on out there because I hear this all the time. It's almost like a badge of honor. Somebody comes to me and they're like, Steve, I just fired my CPA. And I'm like, okay, right? You seem very thrilled today. It's almost like revenge. They're like, oh my gosh, I've been oppressed for all this time. Now I fired them and I feel so relieved. So just don't get yourself in that situation. Like I said, there are a lot of great CPAs out there. Just be aware that there's a difference between a CPA, right, and somebody who's in accounting, and then somebody who looks at things from a strategy and finance perspective, because that's how you drive real value and improve performance. Not necessarily from your CPA, but from somebody who is a strategist who understands the true value drivers of your company. All right, if you want to talk about any of this, or you want to hop on a one-on-one strategy call, you can do that by going to coltivar.com. I'll provide some links in the description below. Thanks for joining me. If you got value out of this, it'd mean the world if you shared it. And until next time, take care of yourself. Cheers.